Damania of Emkay Global Financial Services joins us. Anish, what have you made of the overall movement in the markets? We've seen a goodish amount of money that has come in terms of FII and even some DII purchases. Now that you look at both the IIP number and the forthcoming inflation number and the way crude is trended, do you think that incremental buying is risky?
Yes, I definitely think so. In fact, all the factors which you just mentioned probably will play its part. But interestingly, a couple of things I would like to highlight. One is that when we were talking to a couple of auto companies, they mentioned to me that the last 1.5 to 2 months sales, they had to literally push to achieve their targets. And unlike what they have seen in the previous 9 to 12 months where it was selling fairly easily. Also, when I spoke to some of the finance companies which are lending into the consumer durables, etc., in that space, they are starting to see signs of weaknesses in at the retail level in terms of actual sale of consumer durables. So to some extent, probably I would say that there is some impact of inflation catching up with people. Also, when I met a couple of auto majors, they asked me, they pointed out 3 things. One is that last year, though inflation was good, the disposable incomes were rising faster. So that was good for them, and at the same time asset classes were doing better, like gold, real estate and the stock market. So the wealth effect was really very good. Now going into the next year, if let's say inflation continues to be strong, they are probably seeing some impact of that come into their sales numbers probably towards the second half. So domestic consumption story probably could weaken in the second half of the year. We are already starting to see weakness coming in the capital goods space. Last 3-4 months or 5 months have been slower or declines in the capital goods space, and it continues even in this quarter's IIP numbers. So we need to now really keep a watch on this macro data. And with oil behaving the way it is, I'm not too much worried on the balance of payment situation, but what it can do to inflation could be detrimental to earnings.
Anish, actually that was my next question then. What do you do with these stocks then? Auto stocks, for example, now you will have high base effect also for some of these companies, and while we've already seen quite a bit of increase in fuel prices of late, the price in the hike in crude price has not been passed on because of elections, and once they get over in May, you are likely to see some more hike in fuel prices. So as a sector, would you sell these stocks?
See, what I would like to tell you is that we'll see these headwinds having its impact probably towards the second half, more towards the second half than towards the first half. In some cases in the autos space, probably last year margins were fairly impacted, as in the case of Maruti, on account of currency as well. So probably there they might do a little better. So Maruti could actually gain in margins in this year. Volume growth could slow down from the 20s to the 12-15% or so, but that would still be good because Maruti has fallen. So I wouldn't say a blanket sell on everything, but yes, you will have to have a cautious outlook now on the auto stocks as we go forward. Maybe nothing immediate, but yes, we need to
Anish,
now.
Anish, let's talk about IT then, because getting some news on Polaris. As we head into the earnings season, what's the call on Infosys? And we have seen some sort of outperformance from select mid caps in the IT space. Would that be a space to be in?
See, again, there are mixed signals out here. In the IT space, demand growth continues to be strong. But currency as a factor could impact margins. Though I would always play on the fact that if volume growth is looking strong in IT, I think we should be in IT. So any correction, if it comes through in this space, I would be a buyer in this space. We like Infosys and TCS both at the current point of time. And in the mid caps, we are selective. and we feel that yes, there is a story even in mid caps too. So we will selectively play stocks. We had recently come out with a note about 2 months ago on Infinite Computer Systems. That is one stock which we like. Hexaware was another stock which we like. But a lot of these stocks have run up, so we need to be a little careful as to what valuations we are buying. I would still say in the mid-cap space, Infinite Computer Systems looks good.
Anish, infrastructure. Anything in that space? I mean, we saw some interest return as more and more money started coming into the country. Would you buy any of the infrastructure stocks at all?
Yes. I think for the first time after a gap of, let's say, 18 months or so, I would say that yes, infrastructure stocks looks like we need to look at them. Our criteria of not liking infrastructure stocks was very simple. We said that after every boom bust and the recovery scenario, market always goes towards earnings, and till the time you price in the earnings only, and at least the stocks trade at a fair multiple to earnings, we wouldn't be looking at the infrastructure space. But now with the valuations having come up so much, we have spent about 18 months in terms of their earnings growth as well. Now I feel that there are some infrastructure stocks which you might want to look at on this in this correction period now.
Anish, the space that really shone quite brightly was real estate in March. Something like a DLF was up about 24-25% in a single month. But in the month of April, we have seen some of those gains, being given back. DLF itself is down in the month of April by about 8% or so. What would be the call on the sector and something like a DLF?
Okay, realty sector is one sector we still don't fancy too much. Not that we have big coverage on that at this point of time, but the same logic which probably applied to infra companies applies to the real estate space as well. Till the time you are able to price in earnings, I wouldn't be buyer of that stock. For example, DLF, the expected EPS around 12, maybe 13 to stretch it, and it's trading at close to 20 times forward earnings, and I don't see much growth there at this point of time. So why pay so much for somebody like those kind of earnings multiples? So I would reckon that they have to reasonably fall, just the way some of the infrastructure stocks have fallen to a multiple of earnings which is reasonable in relation to the growth which they are showing. I think till that time I still won't touch realty at this point of time.
Alright, Anish, we'll have to leave it at that. Do you want to make any disclosures?
No.
Alright. Thanks a lot for joining us, Anish, with your thoughts.